Hello and welcome. My name is T.M.Hoy and this is Easy Money, a show about how to finance your business. In the past few weeks, Easy Money has covered various aspects of crowdfunding. This evening's show is in a related area, the do-it-yourself IPO, or everything you need to know about accessing the markets. For the small business owner unfamiliar with securities regulations, financial markets, and obscure investment laws, accessing capital through any kind of broker-dealer or financial exchange is a daunting task. This is no accident. The rules and regulations on how to gain access to capital are purposely complex, difficult to understand, and needlessly arcane. Financial intermediaries have a vested interest in making sure you don't understand how to use financial markets to get the money your business needs without paying them a fat fee first, of course. This article will correct that and give you the information you need to make intelligent decisions about getting capital through markets and guide you through the financial labyrinth that professionals have created. There are many different ways to access financial markets. Some are easier than others, but none, unfortunately, are either easy or simple. Before diving into the ugly mess of rules governing how businesses raise money in public markets, be aware that at a bare minimum, your company must have the following characteristics to even consider pursuing public money. These characteristics are, number one, if you're a startup, you must have an excellent business plan and a decent number of backers, at least a dozen. If you're an existing business, you must have positive cash flow and be generating regular and stable earnings. And two, at least $10,000 to $15,000 for fees and costs. Three, a great deal of patience and plenty of time to fill out forms and create complicated kinds of documents and paperwork. This is the minimum. In reality, raising money from the public is so difficult that very few businesses qualify. But don't let this deter you. If you're persistent, determined, and have a business that is successful, you can use the information given here to get capital. To begin at the beginning, you must start with Section 5 of the Securities Act of 1933, also called the 33 Act. This is the federal law, along with the Securities Exchange Act of 1934, that regulates all sales of stocks and bonds to the public. There are basically three exemptions to filing with the SEC, and by the way, filing with the SEC is a major pain in the butt, which is expensive, time-consuming, and requires that you divulge a lot of complex information and meet difficult standards in order to comply with their rules, which is why the rest of this show is concerned with ways to avoid filing with the SEC. Now, these major ways that you can avoid filing with the SEC fall into three categories. There's Rule 4, parentheses 2, that are called private placements. Rule 503 of Regulation D, which, by the way, is the one that's being affected by crowdfunding, hopefully soon. And 3A11, which are called intrastate offerings. Each of these will be discussed in turn. The first major exemption is for what are called private placements. In effect, they're private sales of stock. With private placements, the issuer cannot advertise. The buyers have to be what are called sophisticated, which means they're accredited by the SEC, and there are restrictions on the number of investors. The resale of the securities and the amount of securities to be sold are also restricted. For all intents and purposes, private placements generally are arranged by investment banks for corporate clients. The securities to be issued under a private placement exemption must be less than $5 million in value, can't be advertised publicly, and must be sold to 30 or fewer investors. Accredited investors are individuals with a net worth exceeding US $1 million and have earnings that are over $200,000 a year. Obviously, this is a big hurdle. The private placements exemption flows into Rule 503 of Regulation D, which is being radically revamped according to changes demanded by the Jobs Act, the Jumpstart Our Business Startups Act, which we've been discussing in the previous programs. In essence, the Jobs Act legalizes crowdfunding and eliminates the needs for startups to file with the SEC in order to sell securities to the public if they comply with certain basic rules. This is an enormous change, and as one might expect of insiders, the SEC and the financial markets are less than thrilled with these changes. Just take a look at the SEC homepage real briefly, and so you can, if you ever have to go there, you can check it out. The SEC has been dragging its feet for over a year, but the demand for implementing these rules is strong enough that finally it will become fully effective, meaning the full legalization of crowdfunding, that is, allowing advertising directly to the public, and that we can expect that sometime in spring 2014. And more on all of this in a minute. As it currently stands, Rule 503 of Regulation D allows companies raising less than $1 million a way to issue securities that's less hassle than usual. Still requires lots of paperwork and providing the info you'd find in a typical prospectus, which is a document that's prepared for prospective shareholders and investors, giving all the details on a company. The third exemption is the interstate offering exemption. This rule allows companies to offer securities without filing with the SEC if the issue is offered and sold only to residents of the state where the business is located. The rules on this are very strict. The company has to be resident in the state where the issue is offered, it has to do its principal business there, and the securities have to come to rest in the hands of residents in that state. Many people over the years have attempted to dance around the SEC filings and rules with it, and as a consequence, selling even a single piece of stock to a non-resident is sufficient to poison the entire offering, that is, render the exemption null and void. Those wishing to take advantage of the interstate offering should therefore be very cautious about how they apply it. Ideally, if your company is resident and does business in one of the large states like California, New York, Illinois, Texas, there's a chance that you can use this exemption. There's plenty of money in the large states for local businesses, and if you're acting in good faith, you pay for a decent local securities attorney, and you're careful, you can probably sell your company's securities to local investors this way, and it is a way of avoiding SEC filing. Since you can advertise the sale of your stock or bonds directly to the public within your state, it may be worth your while to consult an attorney who specializes in this sort of issue and possibly pursue it. But do be careful, the SEC monitors activity closely, and you can get in trouble really fast if you don't play by all the rules. To return to private placements and Regulation D, there's several alternatives for small businesses wishing to raise capital with an IPO or a DPO. IPO, of course, stands for Initial Public Offering, and DPO, Direct Public Offering. IPOs are conducted on actual financial exchanges, whereas DPOs are basically a variety of crowdfunding. It should be noted that most entrepreneurs consider public stock markets incredibly hostile, and this is according to Mark Andreessen, who co-founded Netscape. And in an interview that he gave on the CNBC show Closing Bell, this general partner of VC firm Andreessen Horowitz said that the new running theory among new entrepreneurs is never take your company public, or don't do it as long as you possibly can. After the dot-com bubble burst in 2000, lots of new regulations were heaped on public companies, and these new rules make running a public company very cumbersome and expensive. The cheap money that used to lure entrepreneurs into going public is now made pricey by all of this extra hassle that you have to go through. Corporate governance standards are tricky and treacherous. So consequently, the result has been a huge disincentive to go public, and of course the problem with that is, if new companies don't go public, then you get exactly what we're seeing, which is the number of public companies are falling. Indeed, there are now about half the number of public companies as there were a mere 15 years ago. Restraints are choking the stock markets, and for those who depend on public markets for funding, the future looks difficult, and that was a quote from Mr. Charles Crumpley, who's editor of the Los Angeles Business Journal. He points out that there's virtually no new growth and lots of destruction of public companies. Bearing this in mind, it's possible for a small business or startup to access the financial markets through an IPO. Now, normally, an IPO requires a company to have a minimum $150 million in market value, with 3 years of operating history, solid growth prospects, and preferably a track record of dependable profits. It also costs at least $100,000 to $500,000 and takes on average about 6 months to a year. Now, knowing how hard these conditions are to meet, and since the markets have been lacking new entrants, rules have been loosened up by regulators on many exchanges. Leading the pack was the London Stock Exchange, which in 1995 launched the alternative investment market called AIM. And over 3,000 companies are now listed there. And the rules for listing on the exchange are much more relaxed than that for the LSE proper. In Germany, the newer market was established so startups could list on an exchange, though it has been less successful than AIM, and its future is in question. In the U.S., the California Stock Exchange hopes to open in the summer of this year with an emphasis on helping startups and small businesses access capital. And let me show you their website and take a look at this. There's some really interesting stuff here. Here we go. This is their homepage right here, and shows you how to list a company. Talks about the different requirements that are necessary. You can go on and you can see that they list a number of different ways to help you. And at the bottom, of course, they have all of their information. But that's something that you might definitely want to check into. But in general, for your average company, in the U.S., a small company that's seeking an IPO really has no choice but to deal with what are called the over-the-counter or OTC markets. There are two main and closely related OTC markets, and this is the OTC Bulletin Board, run by FINRA, the Financial Industry Regulatory Authority, which is a branch of the SEC. And then there's also the NASDAQ OTC Bulletin Boards. These are the bulletin boards that most people use. The OTC bulletin boards are electronic quotation services, and let me show you their homepage here. We're going to go to this in just one second. There we go. This is the OTC Pink Sheet, which is the easier to use variety of the OTC markets. They act as a kind of financial exchange with varying levels of difficulty to list and different standards for the company that are applying to be listed. NASDAQ stands, of course, for the National Association of Securities Dealers Automated Quotes, and the bulletin boards have 3 different levels. The easiest to access is called the OTC Pink Sheets, which you're seeing their homepage right here, and this is a centralized quotation service. Companies listed on the Pink Sheet exchange don't report to the SEC or other regulators. There are no minimum sales, profits, or assets required of a company in order to be traded on the NASDAQ OTC Bulletin Board. The Pink Sheets list the riskiest companies, which are often called penny stocks because shares often trade for mere pennies. The Pink Sheets are not actually an exchange, merely a listing service. The Pink Sheets are actually a quote medium for brokers. Consequently, its subscribing members are the ones who decide who gets listed. The Pink Sheets are not a listing service. For those wishing to get listed, it is necessary to find a market maker or a broker who stands ready to buy and sell the stock. A list of market makers can be downloaded by clicking when you visit the website. You'll see very quickly they'll show you how to access different market makers that may take your company on. The next level up is called simply the OTC market, and let's take a look at their homepage here. Let's see here. That's their homepage right there. And the securities that are traded on this exchange are issued by companies who can't or don't want to meet the standards of listing on the NASDAQ exchange. So it's also called the OTC QB. And there on your screen you can see the different levels. The top one, DX, is the most difficult to list on, followed by QB, and then at the bottom the pinks, which are the easiest to actually get listed on. Smaller developing companies that report to a U.S. regulator are eligible to be listed on the OTC QB. And companies might include shells, that is, companies that are legal entities but don't actually do business, and penny stocks, as long as they're current in your disclosure statements and filings with the SEC. There's currently over